we will see US CPI, as reported, hitting double-digit figures both for the USA and globally around in 2027, 2028. There is high risk that the EU leaders need a distraction from their domestic problems. And what better distraction than war? So I think the risk of Europe physically going into Ukraine, support Ukraine against Russia, is a real risk within the next 3 to 6 months. But we then get the big crash, 2027, 2028. The bigger picture is the movement from a unilateral world led by America to a multilateral world led by Russia and China. And this comes to the SCO meeting, which has just been concluded.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Welcome to the podcast, Simon. It's a pleasure to finally host you, and I'm looking forward to this conversation. We'll cover a lot of topics ranging from global geopolitics, the situation in the bond market that is quite distressing, especially in the West, and obviously the outcomes of many developments that we've seen recently in the past days related to the BRICS nations. Welcome to the show, Simon.
Well, thank you very much for having me. I'm honored.
The honor is mine. And the first question that I ask for the first appearing guests on the podcast is the following. What is your most heretical view on the monetary system today?
Most heretical view. Central banks are losing control. Fed looks as though it's going to be even more politicized than it has been. What will emerge in due time from the BRICS and SCO will be their own currency, which will be supported by gold. If I could think out of the box, I will relate a story that was told to me by a close friend about 10 years ago. He's now passed away. He was a senior executive in a major international financial organization based in Washington. So he knew his way around the traps. And don't forget, this was 10 years ago. He said, Simon, I think at some point in the future, there will be $2. There will be a domestic dollar supported by gold that the US owns, and the offshore dollar will be allowed to find its own level. And based on what our technical associate sees, the DXY should be around 50 in 2028. Is that enough heresy for you?
That sounds like a good chunk of heresy that we will take the time to dissect. First of all, I would like to understand more of the frameworks, theories, but also perspectives on cycles that you have. And in the couple of interviews that I've seen from you, I think you base yourself on a couple of them, but I'd like to hear it from yourself to see also how you think and you base your analysis on. What kind of cycles, like the Kondratiev cycle or Elliott wave theory, long-term debt cycle, or even the Gliesberg cycle or other frameworks, do you base always your assumptions on and are able to understand the past, the present, and obviously forecast the future in some capacity?
Oh, that's a big question. Take more than 45 minutes to answer. We look at all sorts of cycles and conclude that we are going into a very volatile and troubling period over the next 3 to 4 years. It's a mixture of geopolitics and economics. It's very likely that the US economy is already in recession and will remain so into the early months of next year. Europe, I have to say, is looking like a basket case. The bond market is telling you that. China is China. I know China very well, having first been there in 1993 and spending 3 to 4 months every year visiting about 80 factories until 2012. China's real GDP growth this year will be around 4%. When you look at the global economy, the issue is debt. And when you subtract surplus government spending into the economy, into the economies of the United States, Germany, Japan, and the UK, they are all actually in recession and have been for some time. One of the problems, in America is that CPI is understated. If you go back to prior to Arthur Burns, who started meddling around with the numbers, and take a guy called John Williams of Shadow Government Stats, who's taken all the maneuverings out of the system, then CPI last year was 10.8%. I saw a report that came from Larry Summers and was promptly deleted, which said that his team took the workings back to 1983 and concluded that CPI last year was 9%. So when you look at consumer spending last year at 3%, what's that telling you? And then you look at the employment stats, which have been heavily manipulated again for years. And as we've seen in the revisions that have been coming out, employment is not what the markets have been assuming. The odds now are that employment is on a descending track, and thus unemployment as a percentage of the population will be rising. So there are two scenarios that I will proffer. The first is my base case, but one in which I'm having an increasing doubts about. The base case goes like this. We come out of the recession due to fiscal and monetary stimulus in all OECD countries, led by America. So growth starts improving middle of next year. Growth is surpassed by rates of inflation. So in terms of 10-year treasury yields, we will first of all see a correction from the 4+% range to around 3% by the middle of next year. But with monetary stimulus, food prices rising, which I'll come on about, and probably energy prices too, we will see US CPI, as reported, not in real terms, but as reported, starting to rise in the second half of next year, hitting double-digit figures both for the USA and globally around 2027, 2028. So if you have double-digit inflation in America and elsewhere, what are the bond vigilantes going to do? Well, they need a return, a real return. So we're going to see 10-year treasuries at some point 2027, 2028, yielding over 10%. What does that do to an indebted system? Crash. So that's my base case, and I'm beginning to doubt whether that will materialize for the following. Europe is in such a mess, not only because of government weaknesses in so many of the countries, whether it be France, UK, Germany, and so on. The electorates are fed up with the power of Brussels. There is a growing electorate opposition to existing governments, and also because of immigration. So there is high risk that the EU leaders, particularly EU, need a distraction from their domestic problems. And what better distraction than war? So I think the risk of Europe physically going into Ukraine to support Ukraine against Russia is a real risk. If that did happen, then when the first shot is fired, money is going to flood out of Europe until Europe imposes capital controls. Maybe capital controls come before the first shot is fired. That's probably more likely. What are the global reverberations of that? Banks are highly interconnected. We could well see, instead of the inflationary takeoff that is my existing base case, we actually go into financial and economic turmoil as soon as that first shot is fired in Ukraine. I've not yet concluded which is the more likely, but I think we will know within the next 3 to 6 months, because by then it will be clear whether the delusional leaders in Europe are going to go to war basically to save their own skins. This is all part of the bigger picture. The bigger picture is the movement from a unilateral world led by America to a multilateral world led by Russia and China. And this comes to the SCO meeting, which has just been concluded and is being followed by meetings in Beijing, military parade tomorrow in Beijing as an 80-year anniversary of the ending of World War II. What a lot of people forget is how Russia and China, back in World War II, came together and fought together against the invasion of China by Japan. The last couple of days, I've been listening to families whose grandparents were involved in that war, and it was pretty bloody. So I think that the parade is probably going to show some of the new missile technologies that China has unearthed. That will send an important message to Washington. Then in a few days' time, we have the Vladivostok meeting. It's the annual Business Economic Forum, attended by thousands of people across Asia. And it will highlight the growth potential of Siberia and the Arctic. So, as part of the bigger picture, we have Washington desiring to strangle China's growth. They fear China's increasingly competitive and efficient manufacturing supply chain, which is only going to get more efficient and more competitive as they have already been using robots, etc., to produce factories with humanoids only and not human beings. Quote one example, there's a smartphone factory devoid of any human beings on the shop floor, producing one smartphone every minute. I think this is one of the reasons why Washington really fears China and fears that China will dislodge America from its dominating position today. So how does this end? I think the end will come one of two ways. The first is that under domestic pressure, Washington will have to become a member country of the multilateral order. As things stand today, that's highly unlikely. The only other option is that around this 2028-2030 period, the decision will be made by war. So those are my broad guidelines, and from those guidelines, one can put together market trends. Equity markets probably will have a decent correction between now and the end of the year. Governments, central banks, come what may, will do what they can to kick the can down the road again. But we then get the big crash 2027, 2028. So the dollar, as I said earlier, will get a vicious dollar rally between now and the end of the year, but followed by secular decline. How much will depend on whether America decides to launch $2, as I speculatively spoke about. Base metals, I did a recent report, like Sunday, I think it was, using published data from the ICSG and refined by good internal data I have in China. Basically, outside China, global copper consumption has been flat compared to last year. No growth. Refined production has been rising, causing a surplus in the first half of the year of around 600,000 tons. Doing some sensible forecasts for the second half of the year based on consumption in China slowing sharply and a modest pickup in the rest of the world, like 2 to 3%, which I think is probably going to be too much, but that's it. We still end the year with a big surplus. So you have to ask yourself, why are copper prices between $9,000 and $10,000 when they should be, based on fundamentals, significantly lower? So the question that you have to ask yourself is, are the fundamentals going to bring prices down, or are the fundamentals going to improve so much that they merge with current prices? From what we put together, both from a fundamental point of view and from our technical associate, we would expect a short-term lift in prices to just over $10,000. But the big trend will then be prices falling to $7,000 in the early months of next year. And if our base case materializes, then we'll see prices doubling by 2027, 2028. Other base metals will follow suit. Gold is a different animal. Gold acts as a secure asset that will maintain its real value through thick and thin. So short term, we can see gold rising maybe around the $3,600, and then a sharp correction, which will coincide with the vicious bear market rally in the DXY, which we are expecting. So we could see prices down as low as 2,800, which would be a wonderful buying opportunity, because that's the last time for many years that we will see prices that low. I'm not clever enough or stupid enough to forecast what the gold price will be, but if the offshore dollar is going to fall by 50%, rather implies that the gold price will double by 2028. So that's our views as to how we see the world.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. That's a lot to unpack here, Simon, and the 45 minutes will for sure not suffice, I'm afraid. But let's take and focus on just one bit. I have a couple of questions, but I'll start with the more obvious one, the one that you just referred to now, is the DXY bearish rally up to the, I think you've mentioned 120 or even more. What will prop up this demand of the dollar, considering that for now, the talks on the streets, what Jay Powell or what Wall Street expects is that they will cut rates soon enough, or that will not materialize? Or what are the factors that will prop
Well,
up this?
I think the market is overly short the dollar, so it is due for a technical bounce. The Treasury needs a firmer dollar for the refinancing that it has to do before the end of the year. So putting it all together, pretty, depending which way you look at it, nasty bear market rally in the dollar, which will be followed by secular decline.
So it'll be kind of the last spike of the dollar until it then drops down dead like a stone up until down the 50s.
The trend will be down sharply, but you'll also have the little rallies. Nothing goes in a straight line.
And so now if we're looking also at the fact that you've mentioned that Europe is in a situation where war would be a good excuse to kind of look away from the fiscal situation. I would like to think a bit more out loud about this, because I think both are actually coming hand in hand, because in order to go to war, you need to finance it. And the yields on the bonds are rising, and we all know that the ECB is keeping them down artificially, and that there's some form of also early yield curve control happening and losing control on the long end. And that will also be challenged with higher inflation. We've seen that now, even Bloomberg now showing or saying that the revisions of the inflation numbers coming up are actually higher than expected, and that with all the facts that we've considered, also the Trump tariffs and the whole situation that we see globally, that we will see higher inflation rates. So we'll be in a stagflationary environment where we have higher yields, higher inflation, and lower economic growth. Will they be even able to pull through and to be able to finance this war at all?
Very, very good question. I guess these governments being governments, they will find a way of raising that money. How, I don't know, but they will. They have to. They need that distraction.
Maybe the digital euro, which will come into place in the first phases of implementation expected in October, might be a mechanism in which, through this digital panopticon, taking hostage the European savers and the creation of a digital euro, bringing more control and thereby maybe more flexibility in terms of funding. Could that be maybe a mechanism or a way for Europe to...
Yeah. I don't know enough about it to come out with an answer. Inflation, it's very interesting that the FAO Food Price Index for July this year is up 7.6% compared to July last year. And vegetable prices in America risen by 35% from June to July this year. Food inflation is going to be a major issue next year and in 2027.
And will that be emphasized? Because I think in an interview from a few years back, you've mentioned something about a Dust Bowl effect that was forecasted for 2025, I think, that would put the Midwest up in a crisis of agricultural harvest.
That is due to come into play next year. It's the 90-year, I've forgotten the name of it, cycle, which 90 years ago created the Dust Bowl, the Midwest Dust Bowl, when the consequence of that was that food prices soared. And that is a real risk for next year. There is another big risk, two more risks actually, weather-wise. A massive earthquake on Russia's peninsula, name begins with K, I can't remember the name. Weather guys that I speak to, who are normally pretty accurate, say there is a real risk emanating from that earthquake of America's northeast having one of the three coldest winters in the last 50 years. What will that mean to business activity, to food prices? The second weather issue is that there's in and around Greenland is what's called the Beaufort cycle, which I've forgotten how many years, breaks up the ice flow, and thus the cold water that has been locked behind the ice flows into the Atlantic and cools down the ocean. The implication is mammoth, because it means that we will no longer be in a long-term warming cycle, but the cycle will be changing in the next 1 to 2 years from warming to cooling. And in fact, NOAA had a forecast in September 19, it might have been. Yes, September 2019, saying we are not going into a cooling weather phase, we're going into a cold one. I need not explain the consequences because so much capital has been thrown at the warming cycle that is just going to be blown asunder. So, more uncertainties, more volatility.
Well, it's that's something that is maybe not in our control overall, but something that might be useful to think of and to prepare also physically, because as we've talked about, there's many financial components to it, but there is also the physical realities, as you just mentioned, about the weather and weather conditions and the whole of the cycles of nature that are bigger than us. What would you recommend then as an individual to be able to prepare for those eventualities? What are, let's say, for your shelters, both financially but also in terms of geographies and physically? How would you prepare for all that?
Geography, that's a personal decision. So I leave that alone. In terms of markets, don't play long-term, follow the short-term cycles. Have on any dip in the price of gold. If you already own gold, buy more. If you don't own gold, buy gold. That is your security. Make sure that your deep freezers are full of food. And if you have a garden, build part or all of it into a vegetable patch.
And so now I want to maybe conclude on the more like the geopolitical dynamics that are happening right now. And you just obviously talked as well about the SCO's, the Shanghai Collaboration Organization's meeting in Shenzhen, is that this is a big, massive pivot and turning point now that we've seen in multipolarity trend that has been already ongoing for at least a couple of years?
I think it is the start of a new global building block. If it is allowed to continue, then the majority of countries outside America and her allies will be part of that group. In PP, in purchasing power parity terms, BRICS GDP is already on a par with America and her allies. The difference is the age of the populations. The BRICS population are young, which means that's where the future growth is. Europe, Japan, and America's populations are growing old, and their economic growth rates, by definition, are going to be much lower. In simple terms, you could say that America, Europe, and Japan's medium-term growth rates, excluding any external factors, is, say, 2%, and the BRICS is 4%. There's the difference.
So would you say that this constitutes then a once-in-a-century economic reset? And what other factors would contribute to that?
Well, I don't know about once in 100 years. It's once in 80 years. It's the 80-year cycle. And one should note who is attending China's military parade tomorrow. Many of the Deep South countries, Modi, Putin, Xi, of course, all the SCO member countries, Turkey, so on and so forth. That tells you a big story. No Western leader is going to be present. The only EU member country is the Prime Minister of Slovakia, who actually, I was listening to his discussion with Putin, and he's sort of putting one step into the Russian camp and taking one step out of the EU's camp.
And how do you think that the US is then positioning itself? Because we've seen, obviously, in the last, at least since April, with the whole tariff tantrum, all kinds of, let's say, events that also marked the presidency on rewiring global trade on the terms that the US is most favorable on. Do you think that this policy led by the Trump administration has been successful or had made any impact in one way or another?
It depends how you define success. If you define success by getting more revenue into the country, yes, it could be successful. Don't forget that there are new legal obstacles which the Supreme Court won't finalize until probably in the autumn. So the whole of this tariff war may be upended by the Supreme Court. But if it goes through, it's going to add, somebody has to pay for the tariff. Mostly it'll be the importer. What does that mean? It means you're going to take 10 to 15% of liquidity out of the system to pay for these higher goods. I read a report yesterday. China exports 178 different goods to China, to America. It's not just the big numbers that the headlines. It's the simple things like a plug, like a steel rod for construction. It's endless. So who holds the whip hand, and how is Washington going to respond?
And there's a lot of talks as well about the fact that the new Genius Act will be also a form or a door to prop up treasuries in the form of stablecoins. Do you believe that will be something that can substantially then help this lack of appetite for US treasuries?
Being honest, I have no clear answer. I speak to a very close retired senior banker who says it's hogwash. But then you talk to others. I mean, Scott Bessent is a clever guy, sensible guy. So maybe there is something to it. On the other hand, what's going to be the reaction of foreign central banks? Do they want this Bitcoin, stablecoin? What is a stablecoin? What value does it have? It's value in the marketplace, yes, but what's behind it? I think it's just going to cause more uncertainty, more confusion.
And lastly, and to conclude, do you see any potential for Bitcoin to have a major significant role in the monetary system? Looking at your reaction, quite the opposite.
The answer is no. What is its value? So I think Bitcoin is still going to go much higher, but the point will come when it's going to collapse in 1-2 years' time. As I said earlier, play the cycles, don't invest long term.
Does that also mean for gold as well, that you shouldn't be holding gold too long?
Gold is a completely separate animal. Gold is for security. In an uncertain world, you need security. So gold will be a primary asset, certainly for the next 5 years.
And what about then other assets in this cycle that you would say that they are fit for this coming short-term cycle?
I always go back to a famous Italian family centuries ago when they had to vacate their lands because of wars. What did they take with them? They took their gold and their art. And when the wars were finished, they came back to their lands over which they had titles to, and they had their gold and their art. So in these uncertain times, you've got gold. Another market to stand the test of time will again be art. But obviously, you've got to be careful what art.
No NFTs.
Art expert. That's the province of my son and stepson.
Okay, well, at least you have someone in the family. Well, Simon, thanks a lot for this conversation. We're reaching the end of our time, unfortunately. Is there any maybe concluding remarks or thoughts that might have arisen from what we've just talked about that you want to conclude on?
I think the conclusion is a very simple one. Don't be the last guy on the dance floor when the music stops.
You're also on Twitter, on X, under the handle Simon HU, and then a lot of numbers that I will not take the time to spell. I will put everything down in the description. Thanks a lot, Simon.
Pleasure. Thank you for having me.